Hello, everyone. It is Sunday, March 13th, and this is episode 54 of Odds Are, your S&P 500 weekly market forecast. All right, let's take a look at the price action last week. All right, so let's take a look if our forecasts were correct. So first of all, did we stay within the expected settlement range? Yes, we did. We stayed within the range of 41.81 and 43.75. The next thing is, did we breach one of the breach points? As we forecasted, yes, we did breach the 42.44 lower breach point. So you see the market activity actually dropping below that on the first day of the week. I mean, Monday's already below that, so we hit that milestone pretty quickly. And then the market moved as predicted. Yes, and so last week I talked about us still kind of poking our head back up to test that midline, the red midline. Now that didn't happen until Friday, but it did happen. So the market did go up and test that red midline. And I also said that if we were to go to the downside, that we would still have a good chance of closing within the expected settlement range, because we would get to the lower edge of that blue shaded area, the Bollinger Band range. And when we got to the bottom of that, that might act as some support, pushing it back up so that we close within that envelope, which is that space below the red midline and above the lower dark blue line, which is the outline of the Bollinger Band range. So right there around that 42.44, I said we'd close somewhere in that range. And we did. So all in all the forecasts were spot on. Let's take a look at the moving averages. We are still bearish on short-term and medium-term, and that is because while we have not had any crazy drop-offs in the last week, we are still making lower highs and slowly just inching our way down and down and down and trailing in that direction. So it's still bearish on short-term and medium-term. Long-term moving averages are still bullish technically, looking at the 50-day versus 200-day. So we are not flipping that over yet. But that could come at any week, especially if we continue moving in this direction. All right, let's take a look at the critical price points for next week. And you see we're starting off around 41.93, and the expected settlement range is between 41.20 and 43.11. Now the odds of that are 72.08% that we will close within that range. And now take a look at the breach points. Now the breach points are actually very close to the expected settlement limits this week. 41.09 on the downside and 43.06 on the top side. But that has an 81.36 odds of breaching. And so again, that kind of tells this story where we can breach beyond the point, and then we have to kind of bring it back in order to close within the expected settlement range. And it happens a lot. It happens a lot that the breach points will get breached, and then the market will either move back down or move back up in order to close within the expected settlement range. I would not be surprised if that happens this week again, especially since they're very close to each other, so it doesn't take a lot of effort for it to pull back into the expected settlement range after a breach. And then the 47.05 parabolic SAR is still way up there in no man's land. I am not even concerned about that going into the week. All right, let's put all this together now into the relative view. So layering these points in here on the chart, you see what I'm talking about, how we are in that middle ground between the breach points and settlement limits, and it could kind of go either way. Now let's play this out. If we go to the downside and we have to stretch that Bollinger Band range, the blue shaded area, down in order to get down there to 41.09, then we'd breach 41.09, and then we would then kind of rubber band back up above 41.20. I think that will take a little bit more effort because we have the support from the Bollinger Band range, and because the 41.09 is actually outside of the settlement range. So that one, let's give it like a 40-60%. So 40% that it breaches the lower, 60% that it breaches the upper breach point. So I think the upper breach point has a little bit better likelihood of being breached. Now that 43.06, that is the upper breach point. So let's play that out. If the market goes up, breaches above 43.06, which is basically where that red midline will be. So that we know has a magnet effect. So it'll go up to 43.06, breach above that, and then here's the key differentiator, right? That red midline could make or break this. If we go above the red midline and then it gets rejected back down, then we close below 43.11, no problem. If we go above 43.06, above the red midline, and then stay above that, and it acts as support, then we're entering into that upper half of the Bollinger Band range, so above the midline, and at that point, we may very well close above 43.11, so not inside the settlement range. Those are the two scenarios I see playing. If we go to the bottom, we still can bounce back up and close within the range. If we go to the 43.06 and breach that, we may not close within the range if the red midline provides enough support to keep us up there in the upper half. All right, now, didn't see that one coming. So last week was one of those rare weeks. I'd say it only happens maybe once every 6 weeks or so, where we will have a very, very bold prediction and say, hey, this thing is going to happen. And it's like a 99% chance of happening. Now, me personally, if someone tells me there's a 99% chance of something happening in the markets, I'm very skeptical. I'm not just going to accept that at face value. I am going to want to test that. And I welcome you guys. I mean, please, go back and take a look at some of the other episodes where I've made those claims. I usually try to put that right in the title of the episode if there's a 99% chance of something happening or extremely high probability. But I'm also open to showing you guys my work. I can show you guys where I'm getting these numbers from. So if anybody's interested, please, by all means, leave a comment or reach out. But we put that out there because we're very confident in it. And it was no surprise to us, basically, when the market did breach one of those breach points, in this case, the lower breach point. So hopefully you guys are seeing this and joining me on this journey and taking advantage of that, or at least trying to. If not, then reach out. Like I said, we can talk about how you could take advantage of those odds and those forecasts and what I would do. I'm more than happy to talk shop at any time. So leave a comment, we'll get in touch. But you can't say you didn't see it coming, especially if we called it out with a 99% probability last week. All right, and now we'll wrap up with the quote of the week, and this is by Mr. Mark Melnick. Now, I'm going to share this quote, and then I'm going to share an interesting little story that kind of makes this quote slightly funny. Which is, so Mr. Mark Melnick says, 99% of traders don't care about Ferraris and yachts. They just want to pay their bills, save a little extra money, and sleep well at night. The only way to do that is to bat 70% or more. Anything less, and these goals are nothing more than a fantasy. All right, so I think there is something that we need to take away from this quote. There's something that I would actually disagree with on this quote, and then there's the funny story behind it. So I'll start with what we can take out of it. We absolutely have to take away that you should not be in the markets because you want to get rich. Now, if you get rich doing this, that's great. And it's because you started off paying attention to the fundamentals, because you had a passion for it, because you had the support for it. There's a lot of things that go into it, but you can't start off saying, oh yeah, my goal is because I want to get a Ferrari and a yacht. That's not my goal. I don't want a Ferrari and a yacht. I want a Bugatti and a jet. But anyways, you can't go into it thinking that way. So making sure that you have the right mindset going in. The other thing is, the only way to do that is to bat 70% or more. I actually like 80% or more, but that's just me. And it's great that he's calling out that you need to have the odds in your favor. We're all about that here, obviously. Odds are. But there's a missing piece to this equation, because picture this. If you have a system that is batting 70%, or correct 70% of the time, and you make $1 every time you do that, well, out of every 10 trades, you're going to make $7. But if those 3 trades where you lose $3, so the risk-reward ratio is so you could win $1 or lose 3, then those 3 other times are going to drag you down, because for every 10 trades, you're losing 9 and making 7. So 70% is not good enough. You need to have 70% and also factor in what is your risk-reward ratio in order to make sure that your system's going to make money long-term. And then the last thing is that it's just ironic that this guy actually got arrested for some scheme, so he was obviously lying about not caring about the Ferraris and yachts. Obviously, he was not counting himself in the 99%, but the 1%. But hey, people are going to do stupid things, and we can still learn from what they said and what they did. Let's just not repeat it. All right, guys. On that note, I will see you guys next week. Enjoy your trading week, and we'll come back and see what happened next Sunday.